Let's get started. I'm Richard Calhoun, real estate broker with Creekside Realty. Been doing this for 40 years. Been doing stats since 1998. What we're here to do today is discuss what's going on in the marketplace in the last week and the impact that's had. Here's the first graph. What we're looking at here is two components. The inventory, the supply side has two lines. The first is the blue line down here. It's just below the 5-year median, which is the yellow line. Because it's below the 5-year median, it does mean that we have a little bit less inventory right now than we historically have, but we're not talking about a significant number. We're talking somewhere around about 97% of the normal inventory. But keep in mind, this is what I call the macro data. This is Santa Clara, San Mateo County, single family condos and townhouses all blended together. And there is no such product out there in the real world. So you can have shortages in some areas and a surplus in other areas, resulting in the balanced marketplace. Because if you listen to the media, everybody's screaming there's a lack of inventory. What I will maintain is it's this red line, which is the number of new offers. It's the demand side. The demand side is way above where it historically has been. If it was at the historical levels, it would be on the yellow line at 100%. It's sitting up here at somewhere around 122%. You can see a few weeks ago it was at 140%. So it's the demand side of the equation that is causing the hot real estate marketplace we have, not a complete lack of inventory. Yes, there's never been a lot of inventory in Silicon Valley, and the inventory levels have been decreasing, even though the valley is getting more populous. So in general, there is a lack of supply. But to say that we have no inventory when you're essentially at the 5-year median doesn't make a lot of sense, in my opinion. And then the gray line is the least significant. That's just the number of new listings that came on the marketplace this year compared to what you'd expect for the 5-year median. And it bounces around a little bit because holidays move from one week to another week, and real estate is very cyclic and fluctuates quite a bit, which is why I typically use a 5-week median. To find out what's happening in the marketplace right now, I'm using the 1-week macro data. Now we're shifting to what I consider to be the most important data point, and that's days of unsold inventory. That's the supply-demand ratio. How quickly would everything sell at the given rate of sales? The vertical purple line is the split between 2020 last year and 2021 this year on the left, because I go by week number. So we're now in week number 19. So you can see the data is down here somewhere around 22 days of unsold inventory. You'd expect it to be right about 30 days of unsold inventory, because the last 5 years, and it's not the last 5 years anymore, it's 2015 through 2019, those were all strong real estate years in the Silicon Valley. And so we're stronger than a strong year is what we're basically at now. The reason the bottom part of the graph is shaded is I consider anything below 40 days of unsold inventory to be a red hot seller's marketplace, anything above 80 to be an ice cold buyer's marketplace, and in between 40 and 80 is sort of a balanced marketplace where buyers and sellers sort of have an equal footing. It is interesting, we spend very little time in a balanced marketplace. We seem to be either transitioning, is about the only time we're in a balanced marketplace. So we're typically either in a buyer's marketplace or a seller's marketplace. This is looking at the weekly distribution of the sale price to list price ratio. So I look at the sale price to list price ratio of every single transaction, plot it out for the given week. I go from the 0%, the top 5% down to the bottom 95%. And the only reason I don't go all the way down to 0 and all the way up to 100% is those outliers just are really insignificant, and they really mess with the vertical scale because they jump so much. And basically, as you move along the direction of the red line, you have an improving marketplace. The current month is the purple line, which you can see is pretty well hidden. It's towards the top of the graph, which is a good thing. This is the best month, the dotted line out here, that we've ever had. This is the worst month we've ever had. So you can see we're well within that range. And also notice that all these lines are solid, which are the more recent 8 weeks. Then the dashed weeks are the preceding 8 weeks, and then the dotted lines are the 6 weeks before that, because I use 2 for the extremes. So basically, you can see the market has been gradually improving in this direction, because notice mostly dotted lines, then mostly dashed lines, and then mostly solid lines. And again, we're right up there in the top. So that means basically the last couple weeks have been the most overbidding. Now, if I was to actually look at it, I would say this sort of orange line is the highest, and that orange line is back on April 24th. Is there any significant difference between any of these 6 lines that are all clustered right together? Not in my opinion. They're all essentially the same. It's just the fluctuation based on what transactions actually happened. This is to give you an idea of what's happened with sale price. It's sort of an unusual thing. I looked at the calendar year of 2020 to come up with the median sale price for each one of the different micro market areas. And then I looked at what the median close of escrow date was. So half the escrows closed before that, half closed after that. But basically, you're in the first week of August. So since the first week of August, and then these are the appreciations that we've had based on the weekly data. And you can see now out here is the current week in the bold, and Santa Clara County is at the bold at the top. And that's bolded because it's the largest sample. And you can see how nicely it just climbs 14.2, 15.7, 15.7, 16.8, 17.5, 18.2. So you can see how that every week we've been going up about 0.75% in appreciation, which is pretty incredible when you think about it. You obviously can't maintain that, but remember again, Silicon Valley typically has this rapid ramp up in prices and then a little bit of a correction. And then the next year it repeats with a rapid ramp up of prices and a little bit of correction, keeps on going. But then when you come down to some of the smaller areas, you can see there's a lot of fluctuation. Cupertino is an example, got up to 13.5%. It's down now to 9.2. Does that mean values are decreasing in that micro market area? No, it just means there's fluctuation based on what happens. And when you get a smaller data set, if you go down to Foster City in San Mateo County, you can see it's all over the place. But Foster City has only a handful of transactions. So it all depends on what happened with those specific transactions, 1.8% versus 11 and 9.7. So I just put at the details there so you can get some concept of the fluctuation. This up here, the county-wide sort of gives you a direction, but you can see we're all seeing fairly strong appreciation. And that does a quick recap. I'll pause, see if anyone has any questions as I go over these URLs. The green is my base URL. That's sort of what you need to get there. If you use that, you get to the YouTube channel, the past presentations. You add in the current year and you get to this live presentation if you join me Saturday morning at 9. And to get the handout, you add in the word handout, the 8-digit year, month, day code. So it'd be 2021-05-15. And then to get to the archives of this session, probably won't get posted till late tonight or Sunday morning. You add in the year. And after any questions are asked, we'll go into a little bit more detail of what's happening. So I'll pause and see if anyone's got a question for me. Not seeing anyone unmuting themselves. As I continue on the details, here you can interrupt if you have a question as I'm going over it. So since I said days of unsold inventory was the most important factor, this is the days of unsold inventory for the different types of properties, single family homes and then condos and townhouses. You also have the different counties, San Mateo County and Santa Clara County. So you can see Santa Clara County single family homes at 17.9 days is the quickest. Typically before the pandemic, San Mateo County would be a quicker marketplace, but it had changed over where Santa Clara County was a little quicker than San Mateo before the pandemic hit. But basically what we're seeing is we're seeing a issue where consumers are driving a little bit further to get a little bit more house and they want the privacy, and that's all shifting the demand to single family homes in Santa Clara County and further away from the works job centers, away from condos and townhouses, and away from San Mateo County. At the top here, days of unsold inventory, you have two equations. You have the active side, the supply side, and then we'll get to the demand side. So on the supply side, I look at what's on the marketplace this week and what was on the marketplace last week. So you can see overall there's been a slow growth in inventory. That growth typically continues until the middle of July, and then it turns around and starts shrinking down again. If you look, there has some fluctuation. San Mateo County, it went up. Santa Clara County went up in single family homes. I think it's condos and townhouses in Santa Clara County, it actually went down. So this one data set went down where everything else went up. So the overall went up. If you look at the offers, instead of looking at this week and last week, I'm looking at the 1 week numbers just to see what happened in the last 7 days. And my calendar week does start Saturday morning, 1 minute after midnight, goes all the way through 11:59 last night. So this is really current data we're talking about. And it just tells you, in the last week, for example, in San Mateo County, we had 100 home sales. In the last 5 weeks, we had 629. So that tells you there's a slowdown for whatever reason in the number of offers in the last week. Because if it was even, you'd expect it to be 125. Now, if you come over to Santa Clara County, again, if you multiply this by 5, you're at 1,300. So again, there's a little bit of a slowdown. If you come over to condos and townhouses, multiply it by 5, a little bit of a speed up, multiply by 5, and again, a little bit of it's actually about flat. In single family homes, there's been a little bit of pause, but is that because inventory in the last week went slightly below normal, so you can't have 140% offers? That's actually where I think the market's at. The change is pretty insignificant. When the market's changing, the rate of change is about 1 day of unsold inventory per day, 3/4 of a change in the days of unsold inventory per day. We're nowhere near that level. This is what the numbers work out to be. You're at basically 18 days unsold inventory in Santa Clara County. That's still essentially the fastest in my career. Yes, a couple weeks ago we were down at 17, but is there a difference between 17 and 18? Not at all in my book. There is a difference between these numbers in Santa Clara County at 17 and 22, and the condos and townhouses in San Mateo County at 30, and now jumping up to 37. Condos in Santa Clara County have actually heated up a little bit at 23. So single family condos and townhouses in Santa Clara County are very similar to single family in San Mateo County. The fastest again is Santa Clara County single family, and the slowest is condos and townhouses in San Mateo County.
Now, the last page, I just don't know what is the reason that under offers, you didn't put a current offer instead of 5 weeks. Because
the 1 week is the current. This is what happened in the last week.
How about the previous and the current, just like the active?
One of the things I'm struggling with is, as you know, I have too much data. There's about 120 slides. What do I show? Yeah. I feel that it's more important to get a 5-week number in there. Based on my experience, if you're looking at 1 week data, you can get wrong conclusions just based on what happened in 1 week. So on the active listings, it's the height of the reservoir. That's already balanced out. And so just, the question up here is, do I just do the current week? And I thought, let's put in the last week just for something to compare it to so you get some sense. I don't think you get the same benefit down here. And if I was to do something like that, I'd probably do the 5-week last week, but to some degree, you'll see that upcoming when we start looking at the offer graph and the days of unsold inventory graph and the supply graph. So you will be seeing it graphically. This is sort of to split it out so you can see it in the different components.
Oh, okay. All right.
If you come up with a real good reason why you would really like to see it, shoot me an email and I'll try to address it. But I think what you're looking for is going to be coming up in a couple more slides.
Oh, okay. Okay. But the numbers I think the numbers to me is much clearer than the slides.
Some people are very much a numbers person. Some person's a graph person.
Yes, there is some difference.
There definitely is.
Okay, thanks.
So now here is sort of the days unsold inventory where you can start seeing it historically. Right now, we're right out here, and you can see it's been basically flat. The red line is Santa Clara County single-family homes. The San Mateo single-family homes has been basically improving a little bit as we come forward. It's got higher as you go back. And again, days unsold inventory is one of those weird data points where higher is bad, because that means the market's slowing down. And you could argue bad from whose perspective? From the overall real estate market's perspective, which unfortunately is typically the seller's perspective, because that means there's appreciation going on, things like that. So, like for example, here, when we were at the heat of the slowdown right at Christmas, which happens every year. So this slowdown doesn't bother me. Neither does this slowdown, in January, because it's actually delayed. It shows up around January 17th. So the thing that sticks out is the pandemic slowdown right here. So you can see that there was a rapid slowdown, and then you can see the rapid improvement, and then you can see sort of a gradual improvement, the holidays, and we came into the spring fever. We improved, and we've been basically at a plateau. Frankly, if I was to look at all three of these lines, Santa Clara County is clearly flat. Condos and townhouses has probably been improving. And I think there's actually been a mindset. I think there's been enough of a appreciation in the single family homes and enough of the consumers that can't get the single family homes that they're compromising, and they're finally moving into this condo townhouse market. And I think that explains this improvement here. The same concept in San Mateo County is if Santa Clara County has gone up in price relative relative to San Mateo County, some of the consumers are going to go back and say, hey, if I can get the same house or very close to the same house in San Mateo County, closer to my workplace, I'm going to stay in San Mateo County. So that's why I think there's been a little bit of improvement in those two lines, where the Santa Clara County has been basically flat, but also the strongest. Now what we're looking at is single family homes only, and we're looking over the past 5 weeks so that there's not a lot of fluctuation. We're looking at days of unsold inventory. These are the actual numbers, so you can get a number. When there isn't a digit, it worked out to be exactly 0, and that's just unfortunate. The software I use doesn't print a decimal 0. So the concept is, the deeper the red, the faster the marketplace, the lower the days of unsold inventory is. Just looking at it, right now, it's almost hard for me to believe this graph is accurate, but it normally is when I start looking in it, because this is Cupertino Sunnyvale. Yeah, okay, Cupertino Sunnyvale at 13 days. That's going to be actually, it says Milpitas up here. I'm going to have to look at it, because Milpitas is saying it's 12 days, and Milpitas is definitely looking to be a lighter shade. So I would definitely rely on the numbers over the shading, and I'm not sure why the shading doesn't look like it works. It's even here, over here, where it's on a white background, the 13.3 looks darker to me than the 12, and that should not be the case. So I have some homework to do. But in general, the lighter the shade of color, the higher the days of unsold inventory, which is why the border right here in Atherton is white, is it's sitting at 45 days. It's sort of in that balanced marketplace. Now we're looking back at the current total inventory. How high is the rate of the reservoir? So here you can now see the blue line is the data. So you can see the inventory was going down as we go back in time, or inventory has been increasing as you come up. This is the actual raw number. So we actually had more inventory, and then we went down. But again, this is macro data, and I think that surplus inventory was not in the single family marketplace, but in the condo townhouse marketplace. And the yellow line is the 5-year median. So right now, for the last 2-3 weeks, we've been slightly below the 5-year median. Then we were on the 5-year median, and starting in week 9 and before, the current data was above. So that was where I was really harping on people, because the media for a while now has been saying lack of inventory, lack of inventory, lack of inventory, and basically until about the 9th week of this year, we had a surplus of inventory if you were looking at the whole thing. But almost everybody focuses on single family homes. They don't look at the condo townhouse market, but those are still available properties for people to purchase. And you can see that the surplus in inventory actually started at the end of last year. I'm guessing that's about week 40. Now we're looking at the new inventory. So this is how much water is coming into the reservoir. Same concept. The blue line is the data. The yellow line is the 5-year median. And this is interesting. Just, you wouldn't expect this kind of jaggedness when you're looking at a 5-year median, but that just gives you an idea of how unstable data is when you're looking at 1 week. The other thing that happens is holidays sometimes move from 1 week to another week, which moves it around, especially holidays like Easter that move quite a bit. Something like the 4th of July would move at most 1 week. When you look at it overall, yeah, you had more inventory coming in the marketplace up until fairly recently, and now it's basically right at normal. Last year, right, and this is shortly after the pandemic, because remember, the pandemic happened back here at week number 10. So 9 weeks, actually 10 weeks past the pandemic, you were almost coming up to normal levels of inventory. By week number 25, you were at normal. And then by week about 32, you were above normal for the rest of the year until you got up to week 13. So that's how you can sort of start seeing some of the longer term trends. This is flipping over to the other side, the demand side. How many new offers were there? And this is the story, in my opinion. The yellow line is where you expect it to be. The blue line is where we are. And until this week right here, which is down a little bit, but I think it's down because, there's a dip down. What holiday is around here? Oh, Memorial Day. So there's normally a dip down for Memorial Day, and Memorial Day is as late as possible this year on the 31st. So that's the kind of shift that I was talking about. So next week, this inventory will actually probably come down a little bit while 5-year median goes up. So you have to watch when you're around holidays, because again, one of my rules is every holiday negatively impacts real estate. The more significant the holiday, the bigger the negative impact is. 2 exceptions, Valentine's Day and Mother's Day, which both have a slight positive impact. impact on the marketplace. And the reason for that is real estate's an optional event. People that get busy with holiday events no longer have the time, the bandwidth to do the real estate optional stuff, and it gets postponed for a week. So it's this surplus, the vertical separation between the blue and the yellow line, that huge extra demand that is what's driving the marketplace. It's not the lack of inventory. And you can see that picked up here probably right around week 32 of last year, and it's been growing. It was pretty constant through here, but you got into the hot spring step up and it really jumped up a notch, and it's been pretty constant. The vertical separation, that is, it's been pretty constant, and that's what you're looking at. And it really the percentage. So putting it on semi-log paper is what I really should do, but then I lose everybody. Now we're looking at the frequency of overbidding. This is how common is it for a seller to get over their asking price. And right now, again, this is macro data, so you can see you're at about 80%. That means 80% of your sellers, 8 out of 10 sellers, are going to get an offer price high, accept an offer price higher than their asking price. Now, some people are going to say that's because agents artificially put the price low. Yeah, that is true. Some agents do that. And even in a down marketplace, an agent may even do their best job. And you may have someone that really wants it because it's their back neighbor and they want to bring their in-laws into their back neighbor, put a gate in the fence and go over and check on them on a regular basis. That kind of thing does happen. So someone can overpay intentionally because that property is more valuable to them. So even in the worst marketplace, we have about 15% overbidding, but there is a huge difference between 15% and 80%. And again, the shading, the blue is 33%, sort of arbitrary, and I'm still adjusting it a little bit, but I'm pretty comfortable with the number. 33% and below is what I would consider to be a cool marketplace. So again, 1 out of 3 sellers getting more than their asking price. It's almost hard to say that's a slow marketplace, but that is in fact really what the dividing line is for this market. Each market has its unique characteristics. Above 50% is what I consider to be a hot marketplace, and between 33 and 50 is what I consider to be a balanced marketplace. This is looking at the different components, the makeup. So Santa Clara County single family homes is the red, and you can see it's the highest. It's probably about 82.5%, picking up a number. San Mateo County single family homes comes next. It's probably around 75%. And then condos and townhouses in Santa Clara County is about 71%. So because it's a weighted average, and because single family in Santa Clara County is the biggest market share, the overall is sitting here at 80, even though 2 of the components are significantly below 80. This dip down here is bad data when we did the data merge in January 22nd of this year. This is the frequency of overbidding geographically. Now I'm only looking at single family homes. The content should be the same. I think I may have figured it out. It may be that the other graph, the days of unsold inventory, may have been my overbid frequency graph duplicated. I'll have to look at that more carefully, because here the colors do work out. 96% is the deepest red, and you can see that's Cupertino Sunnyvale, with 96.5% of the sellers of single family homes in that micro market area getting more than their asking price. Milpitas looked like it was the next shade red, and it's at 91%. You go down into Santa Teresa Campbell, Cambrian, Wool Glen, Santa Clara, it's at 87.5%. So you can clearly start seeing the difference. And this, I'll go back and look, but this is what it looks like. My memory from just a little while ago, this slide is what I had on DUI. So I think I probably posted the wrong slide. So I apologize for that. And the numbers are accurate. The coloring was incorrect. Here's the overbidding graphically. So you can see we were, overbidding after the pandemic. It was coming up slowly. We got into the first of the year, about middle of January, the spring favor takes off and boom, up it comes. And now it's reached this plateau where we're getting around 108, 109%. And that's pretty good. The all-time high for Santa Clara County is about 112. I think it's 114 for San Mateo. I don't have long-term history on this macro overbidding because I'm a firm believer that it doesn't exist. And the only reason I started doing this was wanted to see what the pandemic was doing and have the impact on the real estate market. And of course, like everybody, I thought it was going to go the other way and go down. I had no concept that it would take off, much less take off like it has. This is the magnitude of overbidding in the different geographical areas. Same concept. You can clearly see the color shading is different than the previous slide, so it does look like it's accurate. You have the deep red here in Cupertino Sunnyvale, where they're getting 115.4% of the overbidding. Morgan Hill is at 106, almost the same as East San Jose. Blossom Valley 112, 111 in Campbell. We already did that. Saratoga Los Gatos 108, Los Altos, Palo Alto 108. So you can see that pretty graphically, pretty easily where the hotter marketplaces are. We did this one earlier, just bring it up again just to give it a second shot. So this dotted line out here, this is the best month ever. That was April 2018. The worst month we ever had was December of 2001. This is all now macro data. At the beginning part of these presentations, this was single family data because that was all I had. I went back and got the worst month. Now I'm assuming, and I think it's a pretty accurate assumption, and it's at least pretty close if it's not 100% accurate. Instead of getting every month to get the worst month, single family home was the worst month, or the best month was April of 2018. So I assumed that would be the best month overall because Santa Clara County single family homes is such a big part of the marketplace. So I just went and got the data for the macro, and I didn't get all the months to verify, but I think that's a pretty safe bet. Did the same with December 2001, assumed based on single family homes, that would be the worst macro data. And if it isn't the worst, it's going to be darn close. So that gives you a spread. Again, the purple is the current month. The dotted are the more recent months, but by more recent, they're basically right at the change of the year. Then the dotted lines, the dashed lines are here, basically February and March. And April and May are the solid lines, and you can see they're the more up. So basically, you can see these when you write on the line, those are the people that got their asking price. So here it says that you have to subtract from 100. So basically, 15% of the sellers got less than their asking price for the current, and that's right where the purple is. The best month was out here, where basically 90% of the sellers were getting their asking price or more, and that gives you an idea how crazy. Up here, the best month, 15% of the sellers were getting 25% or more above their asking price. Right now, it's probably somewhere around 7% are getting 25% or more. That's pretty significant. You put your house on the market for $1 million and you get $1.25 million. Some people would go, okay, $1 million is a round price. I'm going to put it out on $1 million. Not my pricing strategy. I try to price things as close as I can to the market value, but sometimes you don't know. Here is just the last 12 weeks to give you the little bit easier read the graphs. Again, the dotted lines are the oldest, but now they're the oldest out of the 12. So that's basically the month of February. The month of March, April is the dashed lines. And for whatever reason, the dashed lines on this line really don't show up as dashed lines, but the more solid ones up here are grouped together. Those are the more recent 4-week. And because there's only 4 of them, you can do the color. So you have the 2 orange, you got the purple, and you got the gray. So those are the last 4 weeks. They're on the leading edge. In general, the trend is up into the right, which is an improving marketplace. Now, this is a little different, and it's not 100% accurate because I'm saying this is May. My May starts on May 1st and goes for 35 days, so it doesn't end until June 4th, and I have to include data from June 4th, so I can't have this data till June 5th. So how am I doing this? I'm looking at, for the current year, I'm using year to date for May, and I'm doing that just to show that single family homes in Santa Clara County is the single best home. And last week, if you go back and look, you'll see that the graph was a little bit higher. So it has calmed down a little bit. I think we now have almost half the data in here, and I see no reason why the sale price to list price distribution should change that dramatically during the month. I will warn you, I don't have the track record to see how it behaves, and sometimes it behaves differently than I think, but I think this starts to be an accurate representation. So you can start seeing, instead of comparing it to April, we're sort of comparing it to May, with the caveat that it's not the full month of May. So the one red line, which I will probably change for purple for consistency of color, is the second best. And I think that's where we will hold. And that's pretty amazing because we've had some good years. I mean, 2017 was a good year, but the real good stuff in 17 started in about August of 17 through about May of 18, June of 18, maybe even July of 18. It might have been a full year. So August of 17 through July of 18. So this was still before it really took off. We're not up to 18, but we're pretty darn close. And for being in a pandemic, that's crazy. Now we're shifting gears back to price a little bit. And there's a lot of data on here. The color coding is based on the median, which is the middle number, which is what most people just follow. So 1.22 obviously is $1,220,000. The first number is the 10 percentile number. So that's the cheapest 10 percentile in a given micro market area. And the number on the far right is the 90 percentile. So for South County, you know that 80% of the homes are between $900,000 and $1.2 $1.7 million with the median being 1.2. So instead of just learning what the median is for an area, you can learn what the ranges are. And you also can quickly see, which most people already know, where the expensive areas are and where the inexpensive areas are. And, some people, ignore the coast over here, but, and it's a rough commute, but, with the pandemic, depending on work lifestyle changes, coming out of there may not be that bad of a commute. It's a different lifestyle than over in the hustle and bustle of Silicon Valley. You can see South County has been more affordable. It's seen rapid appreciation this year. It's the highest number. I think it was at close to 30% up to last week, which is insane when you think about it. But I mean, it's 18, 15% most areas. It's pretty crazy too. This is also the same caveat before. I start on the first of the month. I go 35 days. So I can't have all of May's data. This says I can't have it till June 5th, which is correct. This is looking at single family homes, but this is so you can go back and look at 20 years of data. And so what are we talking about? Inventory, what's on the market, average and median days on market, 33 and 8. If you just look back on there, those look like pretty close to record lows. You come back to 17, you were at 40 and 18. I mean, I'm not seeing any single digits, especially on the median. So yeah, you had 33 on the average just last year, but your median was 19. So it took 19 days to sell half your homes. It took 15 days in 2018, 18 days in 17. We're doing that now in 8. And I will maintain the only reason it's anywhere close to 8 is a lot of sellers and a lot of listing agents will expose the property for at least 4 days, and many agents do it for at least 7. There's some that do 10 days to get 2 weekends in there. So it's artificially high, and it's artificially high every year, but it's artificially higher the closer you get to zero. We will never get to zero. You need some marketing time. So that's telling you the speed of the current marketplace. The other thing that tells you is because there's such a difference between the median and average, it tells you that there's some properties that are coming on the market price that won't sell, because to sell half your homes in 8 and to have the average at 33, that tells you there has to be some homes that are taking 90, 180 days to sell. Now, whether there's price reductions, whether they do a remodel, I don't know all the details of what causes it to eventually sell without looking at them individually, and statistics are to get a handle on the global, not what's going on with any given micro area. Median list price for what's on the marketplace, I maintain that's really not very valuable, because if the low end of the high end of the market slows down, that median number goes up quite a bit, and it has nothing to do with value. Then you have inventory. So let's look at that. Single family homes only, 633. Have we ever had anything close to that? No, the lowest I'm seeing here is in 17 and 960. So we're only having 2/3 of the inventory. So if someone wants to say there's a lack of inventory in Santa Clara County single family homes, I would absolutely agree with that. If someone said there's a lack of inventory in the West Bay Area, I would absolutely disagree with them, because it's essentially normal. What's going on is the demand will get there pretty quickly. This is just the little bit of the house. We talk about the median house, but people don't know what the median house is. So this gives you an idea what the square footage is, bedrooms and bathrooms. Now you start going down to offers accepted. Here is where you start seeing some things that may not make a whole lot of sense. Now at 13 and 8 days, we're not the lowest. Let's look at just last year. That was way low. Oh, well, wait a minute. Why is it crossed out? It's crossed out because, remember, the MLS stopped counting days on market. They didn't want to discourage sellers from putting their house on the market. So they said, if you put your house on the market, we won't count it as being on the market since we're in the pandemic. And they did that from basically the 17th of March until about the 17th of May. And that's what pulled these numbers down artificially. And that's why I crossed it out to remind myself. If you just look at the numbers other than that at 13.9 and 8, there isn't any other year that comes close. And when I say don't come close, yes, they're at 10. But as I explained, it's hard to go from 10 to 8. It's going to be almost impossible to go from 8 to 7. It's just, and it does happen in micro market areas, like Cupertino was at 5.6, believe it or not, at one point. Those are fleeting numbers. They're when you're having a small fluctuation, you have a few more offers accepted in 1 week, and boom, your days on market fluctuates. But again, you can see the numbers. Days of unsold inventory, 15. If you go back and look at it, and this is adjusted for this time of the year because it's basically May, which we're in, we're half of what we are for basically our record. I mean, the best past year was 25. The buyers are going to sense a huge difference between 25 days of unsold inventory and 15. That's why we've had 15, 20% appreciation since the first week in August. Now you look at list price, and this is where list price starts making a difference. And there was one gentleman that would argue with me all the time, you went from 1650 down to 1500, you've lost $150,000, you've lost 10% of your market. No, they're two different sets of data. If the high end of the market isn't selling, this is going to be really high. If the low end of the market isn't selling, this number is going to be really low. You can't compare the median list price of what's on the market to what's selling. So they're two different apples. What you can compare is the 1.5 million to previous years, and you can start seeing the appreciation. Last year, the median was 1.36. The year before that, it was 1.3. In general, real estate is a good long-term investment, and that's what it's basically saying. There wasn't much appreciation between 18 and 19, but I mean, in 19 to 20, $100,000, well, $70,000. Then from 20 to this year, $150,000, $140,000. That's significant. That's 10%. Now what you're looking at is sales per day. You can see this jumped way up, which is what we're talking about. We're talking about the increased demand. Now there is going to be larger numbers, and you just have to go back here to 2012 to get larger numbers, and notice how they were all larger back in this time frame. One of the things that if you look at real estate long term, the number of transactions has been going down, which was part of the reason for Prop 19, was try to encourage people to trade up again to have more transactions. There is no update. Since I'm not even to the date to get the data, there's no way to update it. The updated numbers are to get late reports, to get transactions falling through, but when you're not past the date, you can't update it. And then again, the median price, square footage, median bedrooms, or average bedrooms and bathrooms, and getting down to closings. Closings are important because you get the sale price, so you can calculate the sale price to list price ratio. So you can see you're at 109.8%. And if you come back, you can see you're at 110%. So how can you explain this being higher when the market was cooler? It's easy, in my opinion. In my opinion, anytime the market has an insult, whether it be 9/11, whether it be a recession, whether it be the pandemic, buyers are hesitant. So because they're hesitant, they may overbid as frequently, but they will only overbid hesitantly. So they don't go to 110%, they go to 109%. Instead of going to 120%, they go to 118%. So the top number is down. And that's how I think you explain the magnitude of overbidding not being as significant as you would expect based on the frequency. Frequency of overbidding, 82.6, 83.5. That to me is a dead tie. Yes, it's a little bit lower, but it's a dead tie. It's essentially a tie for first place or second place, depending on how you want to look at it. Then the median sale price down here. And again, I track the 10 percentile as well as the 90 percentile, so you can get a range on what's happening. Because sometimes one price is going up and one's going down. You had that kind of fluctuation back here with the mortgage meltdown that happened in February of 2007. Your cheapest homes went from 636,000 down to 445. That's a pretty significant drop. At the same time, your 90 percentile didn't change. Your median moved a little bit, but not nearly as much as your 10 percentile. So that basically wraps up what I have. I'll take the last 2-3 minutes for anyone that has any questions. Anyone have a question for me? All right. Thanks for joining me. Take care. See you next week.
Oh, okay. Thank you, Richard.
You're welcome, Willie.
Bye. Have a good weekend.